Good morning. All right, everybody's awake. Well, let me second Todd's welcome, and we're very glad that you came today. And I think we have a very interesting program, and we want to get right into it. As you can see, there's the title of my talk. And just a little quick background to get started. We know that starting late last summer, when we knew that we were going to have a truly big crop, monster crop for sure in Illinois, that we started seeing headlines like you see on this slide, everywhere, corn prices going to new lows. And what really got people's attention was when we started seeing corn prices in many areas that started with a 2. And this really did create almost a sense of panic about long-term prospects for grain prices. I like to call that view uber bearish, to use a kind of a term the kids use. And interestingly enough, that view I think has permeated even some of the USDA's latest long-term projections, just released yesterday. Basically they're forecasting 350 corn out as far as you can see. That's a fairly bearish outcome. So in evaluating whether one monster crop can indeed end the new era of crop prices, we need to go back and take a look at what do we mean by a new era, and how did we ever get that idea to start with? Well, starting in 2007 and 2008, as grain prices really took off, Daryl and I took the dangerous step of sticking our necks out and saying, was this signaling a new average price level for grains? Because at that time, of course, that was a question much on people's minds. What kind of range of corn, soybeans, and wheat prices should we consider normal? And were there any new marketing rules that we could apply if this was the new normal? And so basically, we, as you'll see, came to the conclusion for a couple important fundamental market reasons that indeed we were not going to go back to old price levels, and that we were seeking out at that time a new average price level that would persist, we thought, at least for 5 or 10 years. No one knows exactly how long these eras will end. And so we took admittedly very simple approach to coming up with specific numbers in terms of average price levels, and that's illustrated on this chart, which shows the monthly average price received for corn for the entire state of Illinois, starting in January 1947 through the latest estimates that we have for November 2014. And you can see up through the early 70s, the price of corn averaged $1.28 here in Illinois. And then suddenly in 1973, the average jumped to $2.42. Like I like to say, for most of my career, if someone asked me to estimate where the price of corn in central Illinois was going, you just had to give them one number, $2.40. And that would always be a pretty good forecast. Of course, there was great variation around that, but you can see that for basically 3 decades, the average was very steady. And then in the fall of 2006, we can see the dramatic run-up in corn prices that began. And what we did to come up with a forecast, we developed this really sophisticated statistical model where we said if the jump in the average price in the new era that started in 06 was proportionately the same as the jump that happened in 1973, we would go to 460. And that's how we came up with our new era price projection. Now, there was a lot behind that. We would have never published that number if we weren't confident that that seemed to be in agreement with where the markets were trading and our assessment of the underlying fundamentals, which we'll have more to say about in a few minutes. Now, when we first published these estimates in the first part of 2008, we actually took a lot of heat that we were wild-eyed optimists. And now let's see, we're missing, there we go. We also projected price ranges, and you can see that those did a pretty good job of encompassing the range of prices that we've experienced in the last 6 years. But on the key point, the average since fall of 2006 has actually been 487. So remarkably, we were too low, but certainly we're pretty proud that that turns out to have been a pretty decent ballpark figure for the first 8 years of this new era. So that's where we stand, and we think that our approach and the logic behind it has certainly worked pretty well. We did something similar in soybeans and came up with a new era average of 1104 for soybeans, but we came up with that number a little bit differently than we did for corn. We thought that this was a corn-driven new era, and as you'll see, mainly driven by new biofuels demand. So we simply priced the average for soybeans would be priced at a ratio between soybean and corn prices of 2.4. So we just take 460 times 2.4, and that gives us the 1104. So how did we do in soybeans at 1104? Oh, there it is. You can see the average turned out, once again, we undershot what looked like a too high a price by many, turned out to be low by about 70 cents per bushel. Wheat, similar, we just priced it relative to corn, so you get 460 times 126, which is a historical ratio of soft red winter wheat prices in Illinois to corn, and that gives us a price of 580 a bushel, and came pretty close. The average the last 8 years is 598. So these are what we think are decent benchmark prices for long-run planning. And I think everybody is familiar with the idea that these are certainly long-run averages with huge amount of variation around those averages. But we need something for planning, and these have worked out to be quite good projections. And it's really these projections that have come under question with what has happened, particularly in corn, with the huge crop in 2014. You know, we can see that all of the prices are near the bottom of the range that we project for the new era. And so this has caused many to question and say, does that signal that this new era is over and we're either going back to those 1970s, 80s, and 90s kind of average price levels, or something dramatically lower than what we've projected? And so that's what I want to work out on for most of the remaining time that I have. What do we think the evidence says today about the validity of these projections as long-run averages? Okay? So here's how we're going to take a look at that to start with. We're going to look at the full range of prices in the old era, and so old in this case means mid-70s through 2006. Okay? That's the old era for comparison. And the blue bars on this chart simply represent the height of each bar represents the percent of time in the old era from 73 through 06 that we spent in those various price ranges. And of course, that is centered on the average of $2.42 a bushel. Okay? So that's the old average. And notice that there were, in fact, some months where we had very high prices in the old era. Particularly $4 is a good benchmark, but it sure didn't happen very often, did it? And the way I like to say it, in the old era, you really would have never gone wrong selling $4 corn. Now, what's the new era look like? So this is our projection of what the ranges and frequency of prices will be in the new era that we started in the fall of 2006. And of course, it's centered on $4.80 a bushel. And what we want to ask is, are the current relatively low prices that we're experiencing more likely to have been produced by the blue distribution or the red distribution? Basic question. There's the November 2014 corn price of $3.40 a bushel. And the honest answer with that price is that it could have been generated by either one. But it's certainly more likely to have been generated by the red distribution, simply a price that is in that lower tail. But admit that it's also in the overlap region, so you could argue really either way based on this evidence. But we would lean, particularly with recent price movements, with prices at least 20 cents a bushel higher today than when I originally made this chart, we're moving into an area where prices would be very unlikely to have been generated by those old distributions. They're just too high, very unlikely. But we can also get some important evidence on this question of, is the new era ending, by looking at soybeans and wheat. Because remember, the idea of a new era is that it's not just one commodity. It's all of the major grains going up and staying up. So let's take a look at what's happening in the soybean and wheat markets. Same idea here. The blue represents the old era, this mid 73 through 06. The red is our projection for the new era, and we can see the November 2014 soybean price at $10.15. And here the answer is very clear. There's almost a zero probability or chance that $10.15 was generated by the blue distribution. The price is just simply too high. Pretty much the same story in wheat. The November 2014 was $4.80. There's a small number of bars to the right of $4.80 in the old distribution, but you're looking about a 0.5% chance of a price that high being generated in the from 73 to 06. So what does this mean? What's the practical implication? Is that we clearly have two of the three major grains prices too high to be consistent with an ending of the eras. Corn, admittedly, is a bit lower, but even the probability of 340, 350, 360 corn being generated from that old distribution is pretty limited. So we think this evidence is still signaling that we're in the new era and that we're likely just looking at prices in the lower part of that new era. And to get a little bit of further perspective, let's step back and take a look at what's happening to the key fundamental drivers of the new era. Take a look at those, and then take a look at what happened with the 2014 crops, and I think you'll see a very interesting story emerges. This is the history of corn use for ethanol in the U.S. since 2002-03. And it's important to keep some basic facts in mind. First, as little as just a bit over 10 years ago, okay, I think most of us can remember that, notice that corn use for ethanol was 1 billion bushels. That wasn't that long ago. And in less than a decade, we're now 5 times that amount, 5 billion bushels. Now, it is important also to recognize that the amount of corn that we're grinding for ethanol in the U.S. is clearly plateaued. And it's plateaued right at that 5 billion bushel figure for a good reason that it turns out, mainly due to blend wall issues in terms of U.S. gasoline. But the key is that we're plateauing by historical standards at a very high level. And that particular demand, because of the RFS, the Renewable Fuel Standards, setting basically a safety net at around 5 billion bushels, means this is a very price-insensitive part of the demand for corn. So that's one part of the equation. The second one is the continuing and absolutely remarkable growth in soybean imports by China. And so this shows us going all the way back to 2000. Again, a little over 10 years ago, China was importing around 500 million bushels of soybeans per year. 2014-15, they'll be right at 2.7 billion bushels. That takes about 60 million acres of soybean production around the world. And the other key is, notice the trend. Very steady, very stable progression. And as of right now, that trend shows no sign of abating. It obviously will not go on forever, but at least for the foreseeable future, unless something really dramatic happens to the Chinese economy, this trend seems well in place. So those are the two main fundamental drivers that we see of the new era. So one, high, but, or I should say stable, but very high grind of corn for fuel ethanol. And then remarkably large and continuing to grow soybean imports into China. Now, with that as kind of the overlay that on what happened with U.S. crops in 2014. And I think we'll explain why corn prices went so low and soybean prices have been relatively buoyant by comparison. This chart shows the deviations in bushels of U.S. average corn yields going back to 1960. So we know that corn yields tend to go up by a straight line amount on average year to year, and this measures how much above or below the trend, that trend line, we were each year. And we clearly had a big crop in terms of yield in the U.S., although intriguingly, by historical standards, it was only the 4th largest positive deviation above trend since 1960. So clearly a big crop, does that mean it's a monster crop? Not sure. What really happened is we got a pretty big positive deviation above trend combined with very large acreage to give us the huge 14 billion bushel crop. That's what really happened. And you combine that with the fact that the major demand driver of prices was plateauing, huge crop, plateauing, major driver, and that combination gave you prices in the lower part of the new era distribution. That's the story that makes most sense to us. Soybeans, really interesting. In soybeans, we actually, this case in terms of yield is for much more of a monster soybean crop, again in terms of yield per acre, in 2014 than corn. The 2014 deviation above trend for soybeans, almost 4 bushels per acre, only surpassed by 1994. So we had huge soybean yields, yet prices didn't tank like they did in corn. Why? Just go back to that picture on Chinese soybean import demand. Basically, that's just soaking up even this size of soybean crop in the United States, and that's why soybean prices have remained at, relative to corn, higher levels. Here's the situation for wheat. Here we were actually had, for all wheat in the United States, a crop that was below trend, but kind of in between corn and soybeans, and that's kind of consistent with the price trend in wheat as well. So that's what we think explains why we had such low prices. And in 2000, as we came out of August and into September, we were looking at, I know I'm not trying to speak for Darrell, but I think we would both have thought that yield expectations for corn got a little bit out of control, and we didn't end up with 180 bushel U.S. average yield. It's going to be something probably less than 174. Still a very good crop, but not the kind of crop that we were talking about. And it was that expectation combined with plateauing demand for ethanol that kind of cratered prices. And we've now seen a tremendous recovery in corn prices. We're looking at Central Illinois prices more like $3.80 a bushel today. And those price levels are really not consistent with the idea that the new era is over. So we think when you put the whole picture together, that our original projections still make good sense. Again, as very long run averages, 480 corn, 1104 beans, and 580 SRW. I guess you could kind of say that's our story and we're sticking with it. Now, that's the good news. Now, this is kind of moving a little bit more to the bad news part of the presentation, which is, even if you buy my argument that the new era averages hold, we can go a number of years below those averages as shown in the old era. So this shows the old era price history from 73 through 06. Same monthly average price of corn. The average is 242. You can just look at the chart. You can see that there are long swings above and below average depending on weather and demand conditions that prevail for a given period of time. Well, what we really want to work out on now is, does the current length of a run above or below average tell you anything about what the next run is likely to be. And that's also part of the uber bear argument, which is, as we'll show in a minute, everyone knows we've had a long run of above average grain prices. And the natural human cognitive tendency is to think that has to be offset now with a long run of below average prices, and that's how you get the average. Okay? So what does the data really teach us about that way of thinking about price movements? This kind of strange looking chart, the height of each bar represents the number of months of each run above and below average that we had in the old era. And you can see that there are some long runs, just like you saw in the previous chart. This is just putting into numbers what you saw in the previous chart. We have some runs above average of almost 3 years, a couple of those. And we have some runs below average, more than 3 years, with the longest being, let's see, it was 51 months. You know, we all remember that was from basically 98 through 02. That period hurt. So we were looking at a period that went basically 4.5 years below average. So this is basically what history shows us in terms of the length. But what I want you to see is that there's a long plus or a long minus below average is not necessarily followed by, you know, a run of the opposite kind going forward. You can find every kind of pattern here. Sometimes a long run of positive, like in 98, 92, or 95, 96 is followed by a long negative. It does happen, but not very often. I can find other long positives that were followed by, you know, 7 or 8 months, and then you went back above average again. So the lesson is, you know, there's no real pattern of a big positive being followed by a big negative, or a big negative being followed by a big positive. We just don't know. The next run will be of unknown length, and your best prediction would be the average, which is, you know, around 12 to 18 months. Similar story in soybeans. We see some particularly long negatives in soybeans starting in the 90s. The longest there is almost 5 years below average for soybeans there in the late 90s, early 2000s. But again, the key is that there's not any obvious big plus, big minus pattern. So with that as background, let's quickly review so far in the new era what the runs above and below our new era average look like. We can see that we had in corn, we started 15 months below, 7 months above, 25 months below, and then 35 months above. It's really almost 40 months. There was a brief interruption there for 4 months. So we have come out of a very long run of positive prices above average in corn. Soybeans, even more remarkable. We're looking at an almost 4-year run above average that just ended a few months ago. So this point has a lot of practical importance about what are we looking at going forward. Does the fact that we are 4 years above in soybeans mean that we're going to now endure 4 years below? We could, but the honest answer is that's not what you should expect based on the data. More likely some kind of moderate oscillating pattern of pluses and minuses going forward. So as my final point about whether one monster crop can signal the end of the new era, I've argued the answer is clearly no. We think that those are solid average projections going forward, and it's at least always nice to know that others who you respect agree. And in this chart, I show corn season average price forecast from 2 other sources. The blue bar represents FAPRI, which does statistical modeling at the University of Missouri. And you can see that their forecasts rise from the current marketing year of $3.40 up to around $4 a bushel. And these were their forecasts in October. They've since lowered them slightly. And the red bar is a method that I use to extract a season average forecast out of the futures markets. It's a weighted average of different futures prices after a basis adjustment. And we can see that when I did this on December 7th, the market was at $3.63 for the current marketing year, and then again rising out to about $4 per bushel for the 2017-18 marketing year. And I just checked this morning, since I made this chart, the red bar would basically, all of those would be up 20 cents a bushel. So the market in the out years is now at around $4.20. And so I think this simply suggests that the expectation right now is that we're going to continue to be, for the next few years, in the lower part of the new era price distributions, but the evidence is that clearly we haven't eliminated the new era yet. I mean, it is, of course, possible, but the evidence to date suggests it's still in place. Those are good long-run projections going forward. And with that, Todd says, I'm done. Thank you very much.